So, welcome back. The process of constructing an overall portfolio requires two steps. The first one is choosing a portfolio of risky assets. In other words, selecting the composition of the risky portfolio given the risky assets you have available, given the universe of risky assets. Step two is deciding how much of your wealth you're going to invest in that risky portfolio and how much you're going to invest in the risk-free asset. So this is what we call the asset allocation decision. So in this lecture, we're going to use mean variance optimization to answer these questions. In the process, you're going to learn terms like mean variance efficient portfolio, Sharpe ratio, capital allocation line, and most importantly, you will understand the main intuition and the insight behind optimal asset allocation decision. And now you can use this insight when you construct your own overall portfolio. And the underlying assumption that we are going to make is that you are risk averse, like many of us, and you have mean variance preferences. In other words, you want higher expected returns and you don't want a lot of risk. Now, the amazing insight that will come out of this analysis is that regardless of what your attitude towards risk is, the best risky asset portfolio, the best risky portfolio, the answer to the first question, the first step, in fact will be identical for all investors. In other words, there will be one optimal risky portfolio that is best for all investors, regardless of their preferences for risk. So really then, what will matter for each one of us is simply the answer to the second question. In other words, how much do you want to allocate to the risky portfolio versus risk-free assets? So in this lecture, we're going to start with the second question. And trust me, we will go back and I'll make sure that I've convinced you about the first question later on. But for now, let's suppose that we have already identified what this optimal risky portfolio is. And what all we need to do is decide how much we want to invest in this risky portfolio and how much we want to invest in a risk-free asset. Okay, so remember we assumed that we already know the composition of this risky portfolio. And what we're trying to do is decide on how we combine it with the risk-free asset. Right? So I'm going to look at the case of one risky asset and risk-free asset. Okay, so let's call the risky asset. So this could be a portfolio of stocks. It could be an index. Right? So let's just assume that we know what it looks like. And let me denote the return on this risky asset by RS. Okay? And we also have a risk-free asset. Maybe it could be represented by treasury bills. Right? A risk-free asset. And let me denote the return on that as RF for free. Right? And let's call W the fraction invested in the risky asset, right? So whatever that risky portfolio is. Okay? So now let's write down the expected return that we would get from combining this risky asset with the risk-free asset, right? So well, we know how to write that down, right? What is it going to be? Well, it's going to be the fraction we invest in the risky asset times the expected return on the risky asset plus 1 minus the weight times the return on the risk-free rate, right? So I can actually rewrite this, right, using some algebra, and you can write it as the risk-free rate plus the weight times the expected return on the risky asset minus the risk-free rate, right? That makes sense, right? What is our expected return on this portfolio? Well, it's whatever the risk-free rate is plus however much we invest in the risky asset times the excess return that we're getting on that risky asset or risky portfolio. What about the variance? Well, we know how to write that down too, right? What is it going to be? Well, it's going to be the weight squared of the first asset, the risky asset, times the variance of the risky asset, plus 1 minus the weight squared, right? The weight on the second asset times its variance, 2 times the weights times the covariance between the two assets. But risk-free asset, of course, by definition is risk-free, right? So this is going to be 0, right? And the covariance of a risk-free asset with anything else is going to be also 0, right? So those drop out. Basically, we're left with the variance of the portfolio being simply determined by how much we invest in the risky asset and its variance. Taking square root of both sides, what do we have? Well, the volatility of this portfolio is going to be equal to the weight that we invest in the risky asset times its volatility. Right? In other words, the risk of this portfolio will simply be determined by the volatility of the risky asset and how much we invest in the risky asset. Right? So given a level of risk we desire, right, we choose, we can actually solve for the weight that will give us that as, and that's going to be this. Okay? Now, all right, so we've got these two pieces, right? So let me now go ahead and plug this thing into the weight here, right? What does that give me? Well, bear with me for a second, right? Well, it gives me the following expression, right? So here is the expected return expression, right? And from the previous slide, we got this expression for the weight. So let's now plug that in here. What do we get? Well, times the expected excess return. All right, well, let me rewrite this a little more nicely. What you get is an expression, right, that relates the expected return on the portfolio to the volatility of the portfolio, right? And in fact, this is what we call the capital allocation line. Right? So it's a line that we can draw in the mean variance, in the expected return volatility space, right? And it tells us all the risk and return combinations we can create from using this risky asset and a risk-free asset, right? And the intuition is, look at the intuition. What does it say? Well, it says that the expected return, right, is on this portfolio is going to be given by the risk-free rate plus some reward to risk ratio times risk, right? So let me draw that for you, right? So I'm going to draw this capital allocation line, right? So remember, it lives in the expected return volatility space, right? So the intercept is the risk-free rate. The y-intercept is the risk-free rate. And it just tells us all the risk and return combinations that we can create given the risky assets volatility and expected return. Right? This is the capital allocation line. It gives us all the risk and return combinations that we can create from these two assets, right? So it's kind of the investment opportunity set. Now, the slope of this, so let me write down the line equation again. Right? The slope of this line, we have a special name for it. This is what's called the Sharpe ratio. right? In other words, it tells you how much additional reward you get per unit of risk for holding in the risky asset, right? So it's the return premium that you get for investing in the risky asset per unit of risk. It's also sometimes called the reward to volatility ratio. Right? So this is the slope, that's the, which is called the Sharpe ratio. Right? Okay, so the question, of course, is, right, now that we have the investment opportunity set that consists of investing in the risk-free asset and the risky asset and all the combinations, right? Where along this line do you want to be? Well, how would you answer that question?